the second or third week of March, we got these shelter in place orders. Since then, we have had over 55 million Americans lose their jobs. Since then, we have seen equity markets, they tanked 30% on average, or approximately. We saw Bitcoin drop 50% in a single day. We saw gold go down 12 to 15%, right? All this crazy, crazy chaos. But as soon as that stuff started to happen, as soon as asset prices started to sell off in that liquidity crisis, we immediately saw the government and the Federal Reserve step in, and they dipped back into the 2008 financial crisis playbook. And that playbook was to pump asset prices, to inject as much liquidity as they possibly could into the economy. And so what you saw was two emergency rate cuts, right? Central banks only have two tools to deal with economic downturns. They cut interest rates twice in an emergency measures all the way down to 0%. So we had a 0% rate environment. They then decided to do multiple rounds of monetary stimulus, totaling up to about $3 trillion, give or take. And so in 2008, 2009 crisis, we saw hundreds of billions printed. This time we saw trillions printed. And so when you cut rates and you print a bunch of money, what happens is we literally did an about face. So those equities that had fallen 30% basically skyrocketed, right? They fell off a cliff and then they turned around and they skyrocketed as all this liquidity got injected into the market. Not only was that equities though, gold went from down 12 to 15% to today gold is up between 25 and 30%. Bitcoin went down 50% in a single day. Now it's up year to date over 60%. So what you saw was that injection of liquidity ended up inflating asset prices. At the same time, we saw some anomalies, right? And so take real estate, for example. In the real estate market, if there was a recession and a pandemic, most people would expect residential real estate prices to fall off a cliff, right? To drop drastically. But instead, we saw something different. We saw the median home price in America actually increase. Why? Well, there's a zero rate environment, so there's cheap capital flowing around. So people are incentivized to go borrow that capital and buy new homes. And when they do that, that increases demand for new homes. At the same time, there's a US housing shortage. Every year, about 200 to 250,000 homes aren't built that need to be to keep up with demand. And so you have a housing shortage. So the supply side is less than we need. At the same time, you have a drastic increase in demand. And so what you get is you get a drastic increase in price or an increase in price. And so that's what we saw in the housing market. So real estate was strong, even though we were in a recession and a pandemic. We saw equities recover. We saw gold recover. We saw Bitcoin recover. And kind of we are in the situation where we are today. Now, it's important to call out that right now there is a very, very big disparity between what is going on in the financial markets and the economic realities on the ground. In one side of the world, in the wealthy side of the world, there are people who have made tens of billions of dollars, right? The billionaires in America have made tens of billions of dollars in some cases for a total of almost, I think it's over now, $500 billion. So the richest people in the United States made over $500 billion so far during this pandemic. The poorest people have lost their jobs. Many cases, they can't pay their rent, they can't pay their credit cards, and they're suffering. So how is it that the rich get richer and the poor get poorer? Well, it's because the economic crisis exposes the structural setup of the global financial system. And so what is that, right? This ultimately gets at what can you do at home with your money to benefit from economic chaos and uncertainty, just like the billionaires and the wealthy? Well, so we're clear, this is not financial advice. This is merely an education on how the financial system works. And so key is, first of all, you've got to understand how money works. So when trillions and trillions of dollars is printed, what that is doing is it is making each individual dollar less valuable, right? It's still $1 equals $1, but the value of a dollar ultimately determines what can you buy. So if, for example, $1,000 could buy you a computer, if the value of the dollar goes down, right, the purchasing power goes down, it may now take you $1,500 to buy that same computer. If the value of the dollar was to increase, the purchasing power was to increase, maybe now it only take $500 to buy that same computer. So the computer still does the exact same thing. It still has the exact same value it had previously. It's just whether the dollar is stronger or weaker, what determines whether you need more or less dollars to buy that same computer. Now, this usually plays out over decades, so we don't really see it, right? About 2% inflation. So over a very long period of time, the cost of things will go up, but it's not seen on a day-to-day basis in the United States. We have a pretty disciplined monetary policy. Where you do see it play out, though, is investment assets. So again, if you go back and you look at in March of this year, we saw asset prices fall off a cliff. And then all of a sudden now we see those asset prices having, skyrocketed back. If you look, Bitcoin at one point this year was sitting at 8,000. In a single day, it dropped under $4,000, hit $3,800. Today, it's trading at almost 12,000. Over 200% increase in that asset. Liquidity is being injected into this economy at an incredible rate. So what does this mean for people at home? Ultimately, what you have to do is you have to understand how to position yourself to benefit rather than suffer in this environment. And so what are the rich people doing? How are rich people making billions of dollars during a time when tens of millions of Americans have lost their job? It's simple. The rule is very, very simple. Get out of cash and get into assets. Why? Because the dollar is being devalued systematically and intentionally by the Federal Reserve and people in the government in order to increase asset prices. So this is a rigged game, right? What I mean by a rigged game is that there are decisions being made by elected officials and by Federal Reserve officials that says it is important for the stability of our financial system to ensure that financial asset prices do not fall drastically. We need to inflate those asset prices. We need to pump liquidity into the economy. We need to make sure that there's not a liquidity crisis. And so when they do that, those asset prices explode like we've seen. And so when you're sitting at home, you don't have to be a genius, right? All you have to understand is structurally what is happening and then position yourself to benefit rather than suffer, and then allow the market structure to take over. And so what most wealthy people have done over the last 4 to 5 months is they have gone from holding cash to buying stocks, buying precious metals, buying real estate, and buying Bitcoin. That's what they've done. And why have they done that? Yes, they have conviction. They've done work on the individual assets that they're buying, right? They've got some thesis as to why they should buy one over another. But ultimately, what's driving their decision is the understanding that if I hold a bunch of cash, that cash is going to be devalued and asset prices are going to increase. So in most cases, gold's value has not changed from March to today. What is different about gold? Nothing. What's different is the macro environment and the value of the dollar. That's why gold's price has increased. The value hasn't changed, but the price has changed. And the reason the price has changed is because there was an increase in demand for an asset that's harder to get than something that's fully available. And also the dollar's being devalued. And so you see the gold price go up. So what about real estate? Remember what I said. The value of the dollar is decreasing. And there's a shortage and increase in demand because cheap capital is available. So what happened? The median home price for residential homes in the United States went up. Look at stocks. Stocks saw the dollar being devalued and they saw an increase in demand because when the stimulus checks went out, there's a bunch of data that shows that a bunch of people who took quote unquote free money in the stimulus checks turned around and put it into the stock market. Stocks go up. And so that is what quote unquote rich people are doing. They understand structurally how the market works and they're positioning themselves to benefit from it. And if you are sitting holding cash, you're going to get crushed. If you go back to 2008, 2009 financial crisis, what we know is that the official CPI numbers, which is a measure of inflation, never got above 2%. But those are the official numbers that measure the consumer prices, right? The goods. What we should be paying attention to is two things. There's one nuance. Inflation does not hit every socioeconomic kind of basket or bucket equally. So the top 20% of people in the world, they actually experience very low levels of inflation at all times. The bottom 20% of people can experience very high levels of inflation. There are multiple studies that show and forecast that people in the bottom 20% of populations experience between 6 to 10% inflation coming out of 2008, 2009. They live paycheck to paycheck and they don't have a lot of investable assets. And so if you don't have investable assets and you live paycheck to paycheck, then I think what ends up occurring is you are going to experience inflation at a different level than people who have all investable assets, right? Most rich people don't have a lot of cash sitting around. They're sitting in financial investments. Those investments appreciate over time. And so holding cash ends up being a punishment in the financial system we live in today. And so rich people are not holding cash. They get out of cash and into investable assets. Now, many people will say, wait a second, I don't have a lot of cash. I don't have a lot of investment assets. How can I go ahead and take the little cash that I have and get started today? The first key is there are 4 key principles or 4 timeless financial pieces of guidance that you should listen to. And they're timeless because they've been true for decades and decades and decades. The first, spend less than you make. It's that simple. If you spend more than you make, you can't make good financial decisions. If you spend less than you make, you have money to invest, to save, to make good, sound financial decisions. So spend less than you make. The second is have multiple streams of income. Don't be dependent on a single one. A bunch of people just got the crash course on the idea. They had one stream of income, their job. They lost their job. Now they have no income. If you have multiple streams of income and you spend less than you make, that will solve a very high percentage of your financial problems. The third thing that they do is that they have a very long time horizon, and that long time horizon comes with a lot of discipline. And then the fourth rule is to simply get out of cash and get into real assets so that you can benefit from inflation rather than being punished by it. It's not that hard. If you can get out of cash and you can get into investable assets, you will see the price of those investable assets increase in price over long periods of time because inflation will inflate the value of that asset. And so that's the game. Spend less than you make, have multiple streams of income, have a very long time horizon and be disciplined, and then simply get out of cash and get into investable assets and let the market structure take advantage or go to work for you. That's it. That's the whole game.